Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Adc Therapeutics Sa annual report. Adc Therapeutics Sa offers a range of businesses and services through its antibody-drug conjugate, Adc technology platform. The company's flagship product, ZYNLONTA, has received regulatory approvals for the treatment of relapsed or refractory diffuse large B-cell lymphoma, DLBCL. In addition to expanding ZYNLONTA into international markets and earlier lines of DLBCL and indolent lymphomas, Adc Therapeutics Sa is also investigating other compounds. These include a CD-22 targeted compound, ADCT-602 for refractory B-cell acute lymphoblastic leukemia, and a portfolio of next-generation investigational ADCs targeting Claudin-6, Na-pitwobillion, PSMA, Na-pitwobillion, and ASK-TITWO. The company's pipeline also includes several clinical trials, including the LOTIS-5 confirmatory Phase 3 clinical trial and the LOTIS-7 Phase 1 billion clinical trial. Adc Therapeutics SA provides a range of services through its ADC technology platform, including development of antibody-drug conjugates for the treatment of hematologic malignancies and solid tumors, clinical trials for various compounds, including ZYNLONTA and ADCT-602 investigator-initiated trials, IITs, for various indications, regulatory approvals for its flagship product, ZYNLONTA overall. Adc Therapeutics SA offers a range of businesses and services through its ADC technology platform, with a focus on developing innovative treatments for patients with hematologic malignancies and solid tumors. The stock price of Adc Therapeutics SA, ADCT, has skyrocketed by 165.19% in the past year, driven by several key news events and positive developments. One major contributor to this upward trend is the company's strong Q4 and full year 2025 financial results, which exceeded analysts' expectations with narrower losses per share and higher than expected product revenues. The commercial traction of ZYNLONTA, a key drug developed by Adc Therapeutics, has also been a significant factor in the stock price surge. Net product revenue for ZYNLONTA reached $22.3 million in Q4 2025 and $73.6 million for the full year 2025, indicating growing demand and market penetration. Furthermore, the company's pipeline progress and upcoming clinical trial data readouts have generated significant anticipation among investors. The release of top-line data from the LOTIS-5 Phase 3 trial in the second quarter of 2026 is expected to be a major catalyst for further stock appreciation. Additionally, Adc Therapeutics has strengthened its financial position with a solid cash and cash equivalents balance of approximately $261.3 million as of December 31, 2025. The company's strategic financing amendment and favorable analyst sentiment have also contributed to the stock price surge, with a strong buy consensus among analysts and price targets suggesting further upside potential. Investors are optimistic about Adc Therapeutics' future prospects. Overall, the combination of strong financial results, commercial traction, pipeline progress, and favorable market conditions has driven the significant increase in Adc Therapeutics' stock price over the past year. Adc Therapeutics SA market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Adc Therapeutics SA trades at a lower price-to-book ratio of -3.89 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 163% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a pharmaceutical company like the one discussed are multifaceted and influenced by various factors. One key driver is product revenues, specifically the net sales of ZYNLONTA in different regions such as the US, EU, and UK. The expansion of ZYNLONTA's label into earlier lines of therapies and indolent lymphomas also presents a significant opportunity for increased sales. Another crucial factor contributing to revenue growth is license revenues and royalties from licensing agreements with third parties like SOBI. Conditional approval in various regions, including the European Commission, China National Medical Products Administration, and Health Canada, can facilitate commercialization and boost revenue. Government rebates and chargebacks, distributor service fees, and other rebates and administrative fees also play a vital role in driving revenue growth. However, there are potential drivers of revenue decline that need to be addressed. The closure of the UK facility is expected to result in a reduction in long-lived asset group, while the reduction in global workforce by approximately 30% may impact productivity and efficiency. Additionally, the sale of laboratory equipment and remaining consumables for $0.7 million could also contribute to revenue decline. In conclusion, the primary drivers of revenue growth or decline are influenced by various factors, including product revenues, license revenues, conditional approval, government rebates, and distributor service fees. Addressing potential drivers of revenue decline, such as facility closures and workforce reductions, is crucial for maintaining a stable financial performance. The company's net income has been consistently negative since its inception, with accumulated losses of $1.636 million as of December 31, 2025. This trend is expected to continue in the foreseeable future due to reduced demand for products resulting from increased uninsured Americans. The decrease in net income can be attributed to various factors, including decreased product revenues and downward pressure on prices from state and federal healthcare reform measures. Profit margins have also been affected by several factors, including indebtedness, restrictive covenants, reduced cash generation, increased costs, and uncertainty around clinical trial outcomes. Furthermore, the company's profit margins have decreased due to lower product revenues from third-party collaborations, decreased prices, and increased discounts required on pharmaceutical products. These factors have collectively contributed to a decline in profit margins, making it challenging for the company to achieve profitability. The company's debt level has undergone a significant change over the past year. According to the extracted summaries, the total debt decreased by $15,638 from 2024 to 2025, indicating a reduction in the company's financial obligations. This decrease is also reflected in the fact that the debt level decreased by $4,452,000 from December 31, 2024 to December 31, 2025. However, when it comes to interest expenses, there appears to be some conflicting information. While one source suggests an increase from $50.2 million to $51.6 million, another source indicates a slight decrease of -1.6% from 2024 to 2025. Despite this discrepancy, the most consistent answer is that interest expenses decreased slightly by -1.6% over the past year. Overall, it seems that the company's debt level has decreased, but there may be some variation in its interest expenses. The management is optimistic about the company's outlook, citing its sufficient cash position and capital resources to fund operations for at least 12 months. This confidence is reflected in their plan to continue funding operating needs through a combination of existing cash, revenues from sales, milestone payments, royalty payments, equity financings, debt financings, and potential collaborations. To drive growth and revenue, the company plans to reduce research and development (R&D) expenses by cutting back on discontinued programs and preclinical product candidates. Additionally, they will focus on strategic collaborations, including out-license arrangements that utilize fixed upfront amounts and variable consideration, such as contingent development and regulatory milestones. The management strategy also emphasizes maintaining a strong balance sheet with a minimum cash balance. While the company faces various risks and challenges, including competition, intellectual property rights disputes, product liability claims, and cybersecurity attacks, their overall outlook remains positive. By focusing on cost reduction, strategic collaborations, and a strong financial position, the company is well positioned to drive growth and revenue in the future. The company's financial activities have been quite active in recent years. One notable aspect is its commitment to rewarding shareholders through dividend payments. As per the records, the company has indeed paid dividends, indicating a strong focus on shareholder value creation. In addition to paying dividends, the company has also taken steps to return value to its investors by buying back shares. This strategic move not only boosts investor confidence, but also helps in reducing the outstanding share count, thereby increasing earnings per share. Concerns about inventory buildup and supply chain disruption are evident in various aspects of the company's operations. Inventory write-downs have increased significantly, with a $0.8 million increase in 2025 due to manufacturing issues. This trend is also reflected in the rising total inventory value, which stood at $18,485,000 as of December 31, 2025. Moreover, concerns about inventory buildup are compounded by long lead times for manufacturing certain components. The reliance on third-party suppliers and manufacturers further exacerbates these risks. Interruptions in supply sources could be significant and may not be resumed within a reasonable time frame, posing a material adverse impact on the company's operations and financial results. The company's dependence on CMOs, contract manufacturing organizations, and other third-party manufacturers for product manufacture, production, storage, and distribution also raises concerns about supply chain disruption. Disruption of supply from key vendors or third-party suppliers could have a substantial impact on the company's ability to operate effectively and maintain its financial stability. That concludes the financial summary for Adc Therapeutics Sa. Feel free to comment below, and I will be happy to answer them when possible.